What drives me most crazy about personal finance is not that people make mistakes, everyone makes mistakes. What drives me crazy is that people often make mistakes in the wrong order. They take money that should protect them from emergencies and put it into speculation. They chase stocks while credit card debt is compounding against them at a rate that almost no stock can reliably beat. They open taxable brokerage accounts while ignoring tax-advantaged accounts that were built to help them. They ask which investment will make them rich before asking whether the foundation underneath them is leaking. That is like trying to fill a bucket with water while the bottom has holes in it. The person keeps pouring faster, thinking more effort will solve the problem. But the real answer is not to pour faster. The real answer is to fix the holes. Money works the same way. A good financial life is not just about finding good investments. It is about sequencing. It is about knowing what comes first, what comes next, and what should wait until the foundation is strong enough to carry it. Most people do this backward because the correct order is not exciting. It is much more exciting to buy an individual stock, speculate on cryptocurrency, talk about artificial intelligence, trade options, or chase the next hot story. It is much less exciting to build an emergency fund, pay off credit card debt, understand employer matching, choose between traditional and Roth accounts, and optimize taxes. But excitement is not the same as progress in investing. The boring thing done in the right order often beats the exciting thing done at the wrong time. That is a principle. The purpose of a financial system is not to make you feel clever. The purpose is to make you resilient and free. If you get the order wrong, you can be making money on one side while losing more money on the other. You can feel like an investor while still being financially fragile. You can own assets while one emergency forces you to sell them at exactly the wrong moment. That is not wealth building. That is financial theater. The first layer is not an investment at all. It is an emergency fund. I know that sounds uninteresting, and it is exactly why people skip it. They want the step that feels like growth. They want the stock market. They want the compounding chart. They want the story that their money is working for them. But an emergency fund is how you stop life from turning you into a forced seller. That is a more important idea than most people realize. When a car breaks, when a medical bill appears, when a job is lost, when a roof leaks, when a family member needs help, or when some unexpected expense comes out of nowhere, the person without cash has only bad choices. They can put the cost on a credit card, they can take a personal loan, they can sell investments, they can borrow from retirement accounts, they can ask family for money, they can ignore the problem until it becomes worse. Every one of those options can create a second problem larger than the first. An emergency fund is not just cash. It is decision-making capacity. It gives you time. It gives you room. It gives you the ability to respond instead of react. It prevents a small shock from becoming a debt spiral. It prevents a temporary problem from interrupting a long-term investment plan. This is why the emergency fund comes before most investing. If you invest without emergency cash, you may think you are building wealth. But what you are really doing is building a structure that cannot survive a normal storm. In systems thinking, a system that has no buffer is fragile. A business with no cash reserve is fragile. A country with no energy reserve is fragile. A household with no emergency fund is fragile. The exact amount depends on your life. A person with a stable job, predictable income, low expenses, good health coverage, and no dependents may not need the same amount as a freelancer with irregular income, children, medical risks, and a mortgage. Risk is not evenly distributed. Your emergency fund should reflect your actual life, not a generic rule repeated by people who do not know your situation. But the sequence is important. Start with a small first target as fast as possible. $1,000 is not financial independence, but it can stop many minor problems from becoming debt. Then build to 1 month of living expenses, then 3 months. Then, if your income is unstable or your responsibilities are large, build towards 6 months or more. The goal is not to hoard cash forever. The goal is to create a shock absorber. That shock absorber has psychological value too. People underestimate this. When you have no buffer, every unexpected expense feels like a threat. Your nervous system becomes part of your financial plan. You make worse decisions because you are under pressure. A modest emergency fund can improve behavior. It can make you less impulsive. It can make you less likely to panic. It can make you less likely to sell investments at a loss. It can make you less likely to borrow at terrible rates. That is why the emergency fund is not a low-return asset. It is a high-return protection layer. You cannot measure its value only by the interest it earns. You measure it by the mistakes it prevents. Once that first layer is in place, the next major issue is high-interest debt. This is where people often behave irrationally because they separate debt from investing in their minds. They say, "I am investing for the future," while carrying a credit card balance at 22%. That is not investing, that is leaking. If you have debt costing you 20% or more per year, paying it down is economically similar to earning a guaranteed return equal to that rate. In practical terms, it is better than almost any investment you can reasonably expect to make with low risk. The stock market can do well over long periods. It can also fall sharply, it can go sideways, it can disappoint for years. But a credit card charging you 22% does not need a bull market. It compounds against you every month. That is why high-interest debt is financial cancer. It grows whether you feel motivated or not. It grows whether the economy is good or bad. It grows while you sleep. A person who invests while carrying this kind of debt may look sophisticated, but the balance sheet says something else. It says the person is trying to earn uncertain returns while paying guaranteed losses. That is usually a bad trade. The correct approach is to list the debts, the balances, the rates, and the minimum payments, then pay the minimum on everything and direct every extra dollar toward the highest interest debt first. This is the debt avalanche method. It saves the most money mathematically because it attacks the most expensive liability first. Some people prefer the snowball method where they pay the smallest balance first for psychological motivation. There is nothing wrong with recognizing psychology. If paying off small debts first keeps you in the game, that has value. But mathematically, the avalanche is usually superior. The key principle is that expensive debt must be eliminated before serious investing begins. Not all debt is the same. A low fixed-rate mortgage is not the same as a credit card. A student loan at a low rate is not the same as a payday loan. A business loan used for productive capacity is not the same as consumer debt used for lifestyle inflation. So the principle is not debt is always bad. The principle is that high interest debt creates a guaranteed drag that must be addressed before you chase uncertain upside. There is one major exception to this order, and it is employer matching. If your employer offers a retirement plan match, you usually want to contribute enough to get the full match even while you are paying down high-interest debt. Why? Because the match can be an immediate guaranteed return that is too large to ignore. If an employer gives you $1 for every dollar you contribute up to a limit, that is a 100% immediate return before the market does anything. If the employer gives 50 cents on the dollar, that is a 50% immediate return. You do not find many guaranteed returns like that in life. This is why employer matching comes early in the sequence. It is not because retirement investing is more urgent than eliminating toxic debt in every sense. It is because free matching money is an unusual opportunity. The system is offering you a transfer, and if you do not take it, you are leaving compensation on the table. That is not discipline, that is waste. The key is precision. Contribute only enough to get the full match while you are still dealing with high-interest debt. Do not use the match as an excuse to avoid the debt problem. Get the match, then send the rest of the extra money back toward the debt. This is how you optimize guaranteed returns. You take the employer match because it is unusually high return. Then you eliminate the high-interest debt because that is also an unusually high guaranteed return. This sequence is not exciting, but it is powerful. There is one practical detail to check. Some employer matches have vesting schedules. That means you may need to stay at the company for a certain period of time before the matched money is fully yours. You should know the rules, but in many cases, even with vesting, the match remains worth pursuing. The broader principle is that compensation is not only salary. A person who ignores the match is rejecting part of their pay. Once you have the emergency fund started, high-interest debt under control, and employer match captured, then the foundation begins to become solid. Now you can move into the tax optimization layer. This is where many people make another mistake. They open taxable brokerage accounts because it feels simple and flexible, while ignoring retirement accounts that reduce taxes and allow more money to compound. Tax advantage is not a small detail. It is one of the major forces in long-term wealth building. When money compounds without taxes dragging on it every year, the difference can become enormous over decades. The investment return matters, but the structure around the return matters too. That is why the next step is often an individual retirement account. An IRA can give you more control than many employer plans. Many workplace plans have limited investment menus, higher fees, and mutual funds that are more expensive than necessary. An IRA often allows access to low-cost index funds and ETFs, which can reduce fees significantly. Fees are a quiet tax. A 1 or 2% fee may not feel large in a single year, but over decades it can take a very large share of the compounding. People focus on market returns because they are visible. They often ignore fees because they are hidden. But hidden costs compound too. In an IRA, you usually have more freedom to choose low-cost funds that matters. For 2025, the contribution limit is $7,000 or $8,000 if you are 50 or older. Those numbers may not sound enormous, but repeated every year and compounded over decades, they can create serious wealth. The choice between traditional and Roth accounts is more complex. A traditional account gives you a tax deduction today, but withdrawals in retirement are taxed as income. A Roth account requires you to pay taxes now, but qualified withdrawals in retirement are tax-free. So the question is whether you want to pay taxes now or later, but that simple question hides a difficult uncertainty. What will your tax rate be in retirement? What will tax law look like in 30 years? What will your income be? What state will you live in? Will you have pensions, Social Security, business income, rental income, or large required withdrawals? No one knows perfectly as a general principle if you are in a low tax bracket now and expect to be in a higher one later. Roth contributions can make sense. You pay the tax at a lower rate now and protect future growth from taxation. This often applies to younger people early in their careers. If you are in a high tax bracket today and expect lower income in retirement, traditional contributions can make sense. You reduce taxable income when taxes hurt the most and pay later when your rate may be lower. But because the future is uncertain, tax diversification has value. That means having some money in traditional accounts, some in Roth accounts, and some in taxable accounts later. This gives you flexibility in retirement. You can decide which bucket to draw from depending on tax brackets, income needs, and future law. Flexibility is valuable because the future is unknown. That is a recurring principle. Once the IRA is handled, many people should look at the health savings account if they are eligible. This is one of the most underappreciated vehicles in personal finance. A health savings account, or HSA, can provide 3 tax advantages. Contributions can be deductible, growth can be tax-free. Withdrawals for qualified medical expenses can be tax-free, tax benefit going in, tax benefit while invested, tax benefit coming out for medical expenses. That combination is rare. The reason many people ignore HSAs is that they think of them only as medical spending accounts. They put money in and then spend it immediately. That can be useful, but it misses the greater power of the tool. If you can afford to pay current medical expenses out of pocket, you can let the HSA stay invested, you keep the receipts. There is generally no time limit on reimbursing yourself for qualified medical expenses, so a medical expense today can potentially be reimbursed years later from an account that had time to grow. This creates unusual flexibility after age 65. The HSA becomes even more flexible. Money used for qualified medical expenses remains tax-free. Money used for other purposes is taxed like a traditional retirement account. Since healthcare expenses in retirement are almost certain, a large HSA balance can become a powerful source of tax-free retirement funding. For one of the biggest costs older people face, eligibility matters. You need a qualifying high-deductible health plan. That is not right for everyone. A person with high medical needs may prefer a different insurance structure. But for those who are eligible and can handle the deductible risk, an HSA can be one of the most efficient accounts available. The principle is not that everyone should use an HSA. The principle is that tax structure can radically change the value of a dollar invested. A dollar inside the wrong structure and a dollar inside the right structure can grow differently over decades. This is why order matters. If you contribute to a taxable brokerage account before using an HSA or IRA, you may be giving up tax advantages that cannot be recovered later. Once the HSA is maximized, the next layer is to go back to the employer retirement plan and contribute beyond the match. This is where the 401k becomes more important again. At first, you contributed only enough to capture the employer match. Now, once high-interest debt is gone and the IRA and HSA layers have been addressed, the 401k becomes a major tax shelter for 2025. The employee contribution limit is $23,500 for most people, with catch-up contributions available for those 50 or older. That is serious capacity to shelter income from current taxation or build Roth retirement wealth, depending on plan options. At this stage, you are no longer just saving casually. You are building a system. The emergency fund protects against shocks. The debt payoff eliminates guaranteed drag. The employer match captures free compensation. The IRA provides low-cost control. The HSA provides unique tax efficiency. The 401k adds large tax-advantaged compounding capacity. This is how a financial foundation is built, layer by layer. Most people never reach this stage because the savings rate required is high. The average person saves too little to maximize even the earlier steps, but that does not make the sequence less important. It makes it more important. If resources are limited, order matters even more. When every dollar has a job, you cannot afford to send it to the wrong place. Now, only after these tax-advantaged opportunities are used does the taxable brokerage account usually become the next layer. This is the step many people want to start with because it feels flexible and exciting. A taxable account lets you buy individual stocks, ETFs, bonds, crypto, related instruments, options, and almost anything available to retail investors. There are no contribution limits, there are no retirement, age withdrawal rules. There is a sense of freedom, but that freedom has a cost. Tax drag dividends can be taxed. Capital gains can be taxed when assets are sold. Short-term gains can be taxed at higher income rates. Frequent trading can create tax friction. The account is flexible, but it is not tax advantaged. That does not make it bad. It makes it a different tool. A taxable brokerage account is very useful for goals before retirement age. It can fund early retirement before retirement accounts are accessible. It can fund a house down payment if the time horizon and asset mix are appropriate. It can create liquidity for large future purchases. It can hold tax-efficient index funds. It can be part of estate planning because of step-up in basis rules under current law. But it should not usually come before the tax-advantaged accounts unless there is a specific reason. Again, context matters. If you are planning to use money in 3 years, it may not belong in a retirement account. If you need flexibility before age 59 and a half, a taxable account may play an important role. If your employer plan is unusually poor, the analysis may change. If you have access to backdoor Roth strategies, mega backdoor Roth strategies, or self-employed retirement plans, the sequence may have additional layers. But the basic order remains powerful. Build the buffer. Stop the bleeding, capture free money, use tax-advantaged accounts, then invest flexibly. That is the core. Now I want to explain why this order works at a deeper level. Every step addresses a different kind of risk. The emergency fund addresses liquidity risk. High-interest debt payoff addresses compounding against you risk. Employer matching addresses opportunity cost. IRA and HSA contributions address tax drag and fee drag. 401k maxing addresses large-scale tax sheltering. Taxable accounts address flexibility and additional wealth building after the protected buckets are used. A good financial system does not maximize one variable. It balances several variables: liquidity, risk, return, taxes, behavior, flexibility, time horizon. Most financial advice fails because it optimizes one factor while ignoring the others. A person says, invest for maximum return, but ignores emergency liquidity. A person says, pay off all debt, but ignores employer matching and low-rate debt. A person says, use the 401k, but ignores fund fees and IRA control. A person says, open a brokerage account, but ignores tax, advantaged space. A person says, hold cash, but ignores inflation and opportunity cost. A principle-based approach asks, what is the constraint right now? If the constraint is no emergency buffer, fix that. If the constraint is 22% debt, fix that. If the constraint is missing employer match, capture it. If the constraint is taxes, optimize the account structure. If the constraint is long-term wealth building after tax shelters are used, then taxable investing becomes more appropriate. The correct decision depends on the weakest link. This is how systems work. A chain is not strengthened by polishing the strongest link, it is strengthened by fixing the weakest one. Many people want to polish the exciting link. They want to optimize stock selection while their debt is destroying them. They want to choose between growth and value while they have no emergency fund. They want to debate cryptocurrency allocation while missing a 401k match. They want to trade options while paying unnecessary taxes. That is not sophistication, that is confusion. The order protects you from confusion. It says, do not move to the next layer until the prior layer is reasonably addressed. Not perfectly addressed, reasonably addressed. This distinction matters because financial life is messy. You do not need a 6-month emergency fund before taking a 401k match. You do not need to eliminate every low-interest loan before investing. You do not need to have every detail optimized before taking action. Perfection becomes procrastination, but ignoring the sequence becomes fragility. The right approach is to build enough of each layer to reduce its specific risk, then move forward. For example, the first emergency fund may be $1,000, then you take the employer match, then you attack high-interest debt. Then you build the emergency fund further. The exact sequencing can vary at the margins, but the logic does not change. The logic is to prevent catastrophic mistakes before optimizing incremental returns. This is very similar to investing in a portfolio before you try to maximize upside. You make sure you cannot be forced out at the bottom. Survival comes first, then compounding. Compounding only works if you remain in the game. High-interest debt takes you out of the game. Emergencies without cash take you out of the game. Tax mistakes slow the game. Fees reduce the game. Panic selling interrupts the game. The correct order is designed to keep you in the game. Now let's consider the person who ignores it. They have $500 in savings and $5,000 in credit card debt. They open a brokerage account because a video convinced them a stock is about to double. The stock falls 30%, then the car breaks. They have no cash, so they add the repair to the credit card. Now the debt grows, they sell the stock at a loss to make a payment, the market later recovers. But they are no longer invested, they conclude investing is rigged. It was not rigged, the structure was wrong, they entered the market with no buffer, high-cost debt, and no plan. That is not investing failure, that is sequence failure. Now consider another person. They build a $1,000 emergency fund. They contribute enough to get the employer match. They attack the credit card debt. They build 3 months of reserves. They max an IRA. They use an HSA if eligible. They increase 401k contributions. They invest in low-cost diversified funds. Only later do they open a taxable brokerage account for flexible goals. This person may not look exciting for a while, but their system is strengthening. Their emergencies become manageable. Their debt stops compounding against them. Their employer adds money. Their taxes are reduced. Their fees are controlled. Their compounding is protected. Over time, the difference becomes enormous. The world often rewards the person who does the boring thing consistently. This is hard for people to accept because humans are drawn to stories. We want the one investment that changes everything. We want the shortcut. We want the stock, the coin, the trade, the secret, the timing method. But wealth is usually built by avoiding big mistakes and letting good systems run for a long time. That is not a slogan. It is how compounding works. Compounding needs time, capital, and consistency. A bad order attacks all three. It reduces capital through interest and taxes. It interrupts consistency through emergencies. It shortens time by forcing withdrawals and panic. A good order protects all three. Now, let us go deeper into the tax issue because it is often underestimated. Suppose two people earn the same investment return before taxes. One uses tax-advantaged accounts properly. The other invests too early in taxable accounts and trades frequently. Over decades, the second person may lose an enormous amount to taxes and friction, even if both choose similar investments. People think investing skill is only about picking assets, but account location is part of skill. Where an asset is held can change the after-tax result. High turnover funds, taxable bonds, and income-producing assets may be better suited to tax. Advantaged accounts, in many cases broad low-cost index funds with low turnover, can be tax efficient in taxable accounts. Roth accounts can be valuable for assets with high expected growth. Traditional accounts can be useful for reducing current taxable income. These decisions can become complex, but the principle is simple. Taxes are a drag on compounding. Reduce unnecessary drag. Do not let the IRS take a larger share of your compounding than required by law. That is not tax avoidance, it is tax efficiency. The law creates these accounts to encourage saving, healthcare funding, and retirement preparation. If you ignore them, you are choosing to make the path harder. The HSA is a perfect example. Many people spend the HSA immediately because it is labeled for healthcare. But if you can invest it and preserve receipts, it can become a long-term tax-free healthcare reserve. Since medical expenses in retirement are highly likely, that reserve can reduce one of the biggest future uncertainties. This is not just optimization, it is risk management. Healthcare costs are one of the major risks in retirement. A tax-free pool dedicated to those costs is valuable because it matches an asset to a likely liability. That is how a good balance sheet works. Assets are matched against future needs. An emergency fund matches near-term shocks. Retirement accounts match future income needs. HSAs match healthcare costs. Taxable accounts match flexible goals and early retirement bridges. When you understand this, money becomes less chaotic. Each dollar has a role. That role determines where it goes. Now, I want to address a common objection. Some people say, I do not make enough to follow all these steps. That may be true in the sense that not everyone can max every account, but the sequence is still useful. In fact, the sequence is even more important when money is tight because mistakes are more expensive. If you cannot do everything, do the highest priority thing first. A small emergency fund, the employer match, high-interest debt payoff. Then the next layer. Do not let the fact that you cannot complete the entire sequence stop you from starting the sequence. Wealth building is not binary. It is not all or nothing. It is a direction. Each step improves the system. Another objection is that paying off debt or building cash feels slow. It is slow, but slow is not bad when the work is foundational. A skyscraper spends a long time below the ground before anyone sees impressive height. The foundation is not visible, but it determines how high the building can rise. Most people want the visible height first. That is why they collapse. The emergency fund and debt payoff are the underground work. They do not impress anyone. They simply make everything else possible. Another objection is that people worry about missing market returns while paying off debt. This can be reasonable if the debt is low interest. But for high interest debt, the math is usually clear. A guaranteed 22% return from debt payoff is extraordinary. The stock market does not owe you that. If the debt is moderate or low rate, then the decision becomes more nuanced. You compare the rate, taxes, risk tolerance, time horizon, liquidity, and expected returns. Again, principles, not slogans. This is why personal finance is personal but not arbitrary. The details vary, the mechanics remain. Now let us talk about behavior. The best sequence in the world fails if behavior is poor. If you pay off credit card debt and then run it back up, you have not solved the problem. You treated the symptom, not the cause. If you build an emergency fund and then rate it for non-emergencies, you have not built a buffer. You have built a spending account if you contribute to retirement accounts, but panic sell during every downturn. You have not built an investment system, you have built an emotional trading account. If you open a taxable account and constantly chase trends, you may create taxes, losses, and stress. The sequence gives structure, but behavior gives durability. So you must understand why the mistakes happen. Was the debt caused by a true emergency or by lifestyle inflation? Was the lack of savings caused by low income or by no tracking? Was the investing mistake caused by ignorance or by impatience? Was the missed employer match caused by not knowing or by not valuing future money? Different causes require different fixes. A principle-based life requires honest diagnosis. You cannot solve a problem you are unwilling to name. Now, if I were designing the order as a mental model, I would describe it this way. First, build the minimum buffer so a small shock does not push you into debt. Then capture free money because guaranteed matching returns are rare. Then attack toxic debt because it compounds against you faster than almost any safe asset compounds for you. Then expand the buffer to a level that matches your real risk. Then use the highest quality tax-advantaged accounts available to you, usually IRA and HSA if eligible. Then increase employer retirement contributions beyond the match. Then use taxable accounts for additional investing flexibility. And goals outside retirement account rules. This is a rational order because it moves from survival to optimization. Survival first, optimization second, speculation last. Most people reverse this. They speculate first, optimize randomly, and think about survival only after a shock. That is why they struggle. The order itself is a protection against human nature. Human nature wants the exciting part first. A good system forces the important part first. That is what rules do. They protect you when emotion would choose badly. Now, let's examine the last layer, taxable investing, more carefully because it is not bad. It is simply later in the sequence. Once the foundation is built, taxable accounts are powerful. They allow early retirement flexibility. They allow you to invest beyond retirement account limits. They allow you to fund medium-term goals. They can be tax efficient if managed properly. They can provide liquidity and estate planning advantages. The mistake is not using taxable accounts. The mistake is using them before the more efficient tools or using them as a casino. A taxable account should usually be simple, low-cost, diversified, and tax-aware, unless you have a clear reason and ability to do something else. Broad index funds can be highly tax-efficient because they produce limited taxable events. Holding periods matter because long-term capital gains rates can be more favorable than short-term rates. Turnover matters, dividends matter, asset placement matters. Again, the boring details compound. If you use a taxable account to trade constantly, you may create short-term taxes and poor behavior. If you use it as a long-term wealth bucket after maximizing tax shelters, it can become extremely valuable. The tool is not the problem. The sequence and behavior determine the outcome. Now, I want to connect this back to the broader idea of financial independence. Financial independence is not achieved by one investment. It is achieved when your assets, cash flow, liabilities, taxes, and behavior are arranged so that work becomes optional or less coercive. The investment account is only one part. If you have no emergency fund, you are not independent. If high-interest debt controls your monthly cash flow, you are not independent. If you miss free employer money, you are weakening your independence. If taxes unnecessarily drain your compounding, you are slowing your independence. If your behavior causes panic selling, you are undermining your independence. Financial independence is a system. The sequence is how you build the system. Each step reduces a form of dependency. The emergency fund reduces dependency on credit. Debt payoff reduces dependency on lenders. Employer matching increases your compensation capture tax. Advantaged accounts reduce dependency on inefficient saving. The HSA reduces future healthcare funding pressure. The 401k builds long-term retirement strength. Taxable accounts create flexible capital. That is the path from fragility to resilience. And resilience is what matters. A fragile household may have investments but still be one emergency away from trouble. A resilient household can absorb shocks, stay invested, and keep compounding. The market rewards resilience because resilience allows time allows compounding builds wealth. That is the chain. Now, there is a cultural problem here too. People are trained to compare visible outcomes. They see someone making money on a stock, they see screenshots, they see a story about a coin that went up, they see an influencer talking about a trade. They do not see the person's debt, taxes, lack of emergency fund, or risk of ruin. The visible part misleads them. The invisible foundation matters more. A person with a boring portfolio, no toxic debt, a strong emergency fund, tax-advantaged compounding, and disciplined spending may be much wealthier in the long run than a person posting exciting trades. Never confuse motion with progress. A slot machine has a lot of motion. That does not make it a wealth-building system. The stock market can be a powerful wealth-building tool, but only when used within a sound financial structure. Without that structure, it can become another form of gambling. This is why order matters more than intelligence. A very smart person can do the wrong things in the wrong order and lose. An ordinary person can do the right things in the right order and build serious wealth over time. That should be encouraging. You do not need to predict the next hot stock to improve your financial life. You need to stop the obvious leaks, capture the obvious benefits, and let compounding work in the right accounts. The path is available, it is simply not glamorous. And because it is not glamorous, most people ignore it. That creates an advantage for the disciplined person. The disciplined person does not need to beat everyone at stock picking. They beat others by avoiding credit card interest, capturing employer matches, using IRAs and HSAs, controlling fees, reducing tax drag, and staying invested. Those advantages are not small. They are cumulative. Each one may look modest by itself, but together they create a powerful difference over decades. This is how real wealth is built, not by one magical decision, by many correct decisions repeated in the right order. Now, I want to leave you with a framework. When you receive an extra dollar, ask what the best job for that dollar is. Does it need to protect you from emergencies? Does it need to stop a high-interest liability from compounding against you? Can it capture an employer match? Can it go into a tax-advantaged account? Can it fund future healthcare tax-free? Can it increase retirement contributions? Can it build flexible capital in a taxable account? The answer depends on where you are in the sequence. That is the whole point. The same dollar has different value in different places depending on your balance sheet. A dollar used to pay off a 22% credit card balance may be more valuable than a dollar invested in the market. A dollar used to capture an employer match may be more valuable than almost anything else. A dollar placed in an HSA may have more after-tax power than a dollar in a taxable account. A dollar in an emergency fund may prevent thousands of dollars of future damage. So do not ask only what is the highest return investment. Ask what is the highest value use of this dollar given my current system. That is a better question. It is also a more Dalio-like question because it focuses on the system, not the object. Money is not only about assets, it is about flows, incentives, constraints, and consequences. If you understand those, you can make better decisions even without being a market genius. The order is the map: emergency fund, high interest debt, employer match, IRA, HSA, more 401k, taxable accounts. But remember, the map is not meant to be memorized mechanically. It is meant to teach a principle: protect yourself first, stop guaranteed losses, capture guaranteed gains, use tax-advantaged structures, then pursue flexible growth. That is the sequence. If you follow it patiently, you may not feel rich immediately, but you will be building the kind of financial structure that can survive setbacks and compound through time. That is much more valuable than excitement, because excitement fades, systems compound, and the person who builds in the right order gives compounding the one thing it needs most: a stable place to work,